Why most breakouts fail and how real ones leave clues. Volume, market structure before and after, and reversal candle behavior. Most losing trades come from breakouts that look real and fail fast. So how can real breakouts be separated from the fake ones? Skip the hunt for a magic indicator and focus on the evidence. Watch volume at the break, study the structure before and after, and pay close attention to the reversal candle that tries to pull price back into the range. Part 1. A simple definition of real and fake breakouts. A real breakout happens when price moves through a key level like support, resistance, or a pattern boundary, then stays on the other side with multiple candle closes and clear follow through. These moves usually come with stronger than average volume, showing that the market actually accepts the new price area. A fake breakout looks similar at first, but the difference shows up quickly. Price pushes through the level, fails to hold, and snaps back into the previous range, often without any real volume behind it. The candles that follow show sharp rejection, telling a very different story than a true breakout. Part 2. Volume. A breakout without fuel deserves suspicion. A valid breakout usually comes with a clear increase in volume. Signs of a real breakout, from a volume perspective, include volume expanding at the moment price crosses the level, followed by volume that stays elevated or at least normal during the next few candles. Signs of a fake breakout look different. Price breaks the level, but volume stays near or below average. In many cases, volume actually increases during the move back into the range, which shows that the market rejected the initial move. In simple terms, when a key level breaks without a real increase in volume, that breakout isn't trustworthy. Part 3. Structure before the breakout. Context matters more than the candle. Many fake breakouts don't fail because of the breakout candle itself, but because the structure leading into the level already looks unhealthy. One of the most common examples appears in long sideways ranges where price keeps testing highs and lows without any real follow through. When a level has been hit multiple times and price keeps snapping back quickly, the market starts building conditions where fake breakouts become far more likely. The way price approaches the level also adds important context. When price rushes into a level with a few large impulsive candles, exhaustion often builds right at the point of the break. In contrast, when price climbs toward the level in steps with small pullbacks and well-formed swings along the way, the structure supports a more genuine breakout. Another clear warning sign shows up when a level has already been pierced repeatedly by wicks. A level that keeps getting violated by shadows and immediately reclaimed usually signals rejection rather than strength. And those levels tend to produce fake breakouts far more often than clean, sustained moves. Part 4. Structure after the breakout. Acceptance or fast rejection. The real difference between a valid breakout and a failed one shows up in what price does after the initial break. In a real breakout, price doesn't just poke through the level and hesitate. It stays on the new side with several consecutive candle closes, showing acceptance rather than hesitation. When pullbacks happen, they often respect the broken level as new support or resistance, and price continues moving in the direction of the breakout. Volatility stays relatively controlled, and price does not fully collapse back into the old range. A fake breakout plays out very differently. Price may cross the level for 1 or 2 candles but fails to hold and quickly reverses, closing back inside the previous range. The market shows an inability to stay above or below the level, almost as if the move never counted in the first place. Long wicks often form on both sides of that level, signaling aggressive rejection rather than acceptance. Part 5. Reversal candle behavior, the signature of a fake breakout. When a breakout fails, the reversal usually leaves a very clear signature in the candles that follow. A strong reversal candle often forms with a large body in the opposite direction of the breakout, and in many cases it engulfs a large portion of the breakout candle itself. Long wicks tend to appear on the breakout side, such as above the level during a failed bullish breakout, showing that price was aggressively rejected rather than accepted. This is where the difference becomes obvious. Real breakouts attract follow-up candles that continue the move, while fake breakouts draw in one or two strong candles that deny the move and push the price back into the prior range. This behavior also creates opportunity in side trading strategies, because instead of trying to avoid every fake breakout, which is unrealistic, the focus shifts toward reducing exposure and having a clear response plan when rejection shows up. Which one feels more dangerous? A breakout with no volume, or a breakout that fails to hold and never stabilizes?